Listen, folks, it's a late night, and I gotta be honest, I only have time for one video tonight, so we're talking about Apple. Gotta be up early in the morning, but we're gonna be talking about Apple earnings for a good reason, folks. A lot was expected out of Apple, for sure, and you see the reaction was relatively negative here, down 2% in the after hours. Started off pretty positive. We're talking about a reaction of over 2% up. Then at one point dipped down over 4.5% and kind of leveled out more towards the 2% range. Still down quite a bit, obviously, but still a positive day for them, seeing as they saw a 4.5% increase in the normal trading session. Now, this stock's been relatively rough this year, but it's been outperforming the market, right? It's definitely outperformed the NASDAQ, down only 10%, where a lot of the stocks we've been looking at are down 30+% in this time frame. Over the last year, still up 22%, so not bad one bit, and obviously 5-year performance quite stellar when you're looking at Apple to Apple. So let's get into this press release and see what we got going with Apple. So, if you look, this is not something you would see that you might think would respond with negativity. We see a GAAP EPS of $1.52 beats by 9 cents, so beat on a bottom line profitability standpoint, and revenue came in incredible, $97.3 billion plus 8.6% year over year. It's a beat by $3.3 billion. That's significant, folks. That's quite significant. It's a massive beat. High single digit as opposed to the low single digit expected is pretty nice. We'll look at these in the chart form because these numbers might not be relevant for you unless you can see a comparison. So we are going to look at the press release here. Obviously, it says there's a new March quarter record, which obviously that is the case. Services revenue reached new all-time highs. Not a shocker. Every quarter it's reaching new all-time highs as they continue to grow the services segment. Really nice to see. So obviously they get here some nonsensical stuff talking there. It's what they always do. Try to sell it. Try to sell the stock to you. They did decide to raise the dividend 1 cent, which is an increase of 5%. Yeah, nothing really crazy there. And it's Q1, so it's what you would expect. It's Q2. I apologize, folks. It's Q2, so nothing crazy there. As far as this dividend is concerned, nothing at all. We are going to look at the goodies as we do. Look, we get in the investor relations page, and we want to find the financial statements. Oh, yeah, we do. Oh, yes, we do. Now, this is what I'm talking about, folks. Let's zoom in a little bit for you because you want to see this. So they've got, obviously, here they list products and services as separate, but obviously there's in a little bit we'll look at the individual products as well. Let's see how that compared. If you look at the product segment, they're giving a year-over-year comparison in terms of the quarters. 77.4. This quarter, 72.6. Of a year ago's quarter, and services, massive growth here, 19.8 compared to 16.9. So very nice to see that as well. Services continue to grow a really larger growth rate, but not necessarily larger dollar amount. So you have to consider that. But a lot more goes into products, and obviously that's the main segment right now. And on a 6-month ending standpoint, you see significant growth in both categories. So that's good. Very good to see that. Net income, obviously one thing I like to see, $25 billion here versus 23.6 of a year ago's quarter. So they, unlike a lot of these companies you've been seeing in big tech, this company managed to grow the net income line year over year. A lot of these companies are posting numbers that are really reflecting what the economy is looking like right now, whereas Apple here, they just continue to print that money. They're printing cashish, folks. That's right. Net sales by segment, obviously, we like to look at each area, and we want to see growth in every area, right? That's a big thing we'd like to look for. And that's not necessarily something that we can see. Good growth in Americas. The Americas, obviously, my presumption would be that would be off of a iPhone strength. You would see a lot of this revenue come into play. Europe saw growth in Greater China. Japan saw a slight decrease of $18 million. And rest of Asia Pacific saw a $500 million decline, actually. So not every segment is growing, but when you look at a 6-month standpoint, the rest of Asia Pacific is actually up, and Japan's actually down over $1 billion. Pretty crazy to look at there, but every other area is doing really well. So I'm curious what that Japan line is about, why that would be the case, where the falter is on that. I would like to look more in depth into that, but nothing really too concerning when I look at this. You see growth pretty well everywhere around the world, just barring one country. So not to the end of the world there. Net sales by category, obviously my favorite thing to look at, because you see where a lot of this is going. And as I suspected, iPhone shows continued strength, massive strength here. Up $2.5 billion year over year in iPhone sales. That's massive. The company still continues to be selling iPhones like crazy. Even Mac. Now this number does surprise me quite a bit. Mac up a pretty decent margin here. 10.4 billion compared to 9.1. That's a pretty nice year-over-year gain in this segment. Not one that usually grows too fast, all things considered. But it's been performing well so far this year. iPad. Now this one's been a bit of a stinker. Not as bad as Q1's numbers were in terms of year-over-year decline. But there is a decline in iPad. It's just a relatively flat segment for them. Wearables came in at a continued growth. Wearables mostly referring to here Apple Watches. Then you also have Apple Home products as well included in here. Succeeding, $1 billion increase year over year there. Good to see it. And services is where you see quite a bit of growth as well. There, $3 billion of growth there. Technically their largest growth segment. Yeah, it is. It's their largest by dollar amount. So pretty significant there. That's good to see that. It's good to see it. Then we're going to get into the balance sheet, something we love looking at. You know I love looking at it. You know I do. And we see a total current asset line right now sitting at $118.1 billion. They compare this to the start of the year here at 134.8. Quite a decline here, and you see most of it in this cash and cash equivalents position. Marketable securities down, accounts receivable down. Most likely this was turned into long-term assets in my perspective. Through an investment standpoint, I would presume, and maybe a little bit of debt paid down, but I would presume this turned into long-term, and it looks like it did. From a total asset standpoint, still sitting at 350 compared to 351, so that really didn't fall all that much. And you see marketable securities grew quite a bit for them, as well as other non-current assets. Curious what that looks like, but yeah. From a liability standpoint, total current liabilities did find a rise here, 127.5 compared to 125, so that did see a rise. And overall liabilities actually declined, so it looks like they paid off a little bit of long-term debt, as you can see here. Total liabilities sit at 283 compared to 287.9. Good decline there, and obviously it was because of this long-term debt they paid down with some, I presume, of that cash that they had here. So, and you can see it looks like it because obviously you see a decline around $7 billion of cash up here. And the total long-term debt shrank by right around, that's right, $6 billion. So it looks like a good bit of that went towards paying long-term debt, which the company has a decent amount of. But when you consider it in 1 year's net income, they really can pay off all of this debt. It's not necessarily the end of the world for them, but they do have a good bit of long-term debt. I think really it's mostly due to product development that they're really focused on right now. Shareholder equity found a rise here, 67.3 billion compared to 63 billion. It's a good looking balance sheet. I've got nothing to really complain about here. And it's headed in the right direction. So I can't say anything negative about it. So it's of a large stature, and I like it. Now you look at the stock, and it's trading at a $2.6 trillion market cap, right? This is a big market cap. Really the most valuable stock right now. The most valuable company is Apple. Given this market cap, quite crazy, and a PE ratio actually going to be sitting closer to 26 after this decline. I think the stock, it's trading expensive for its peers at the moment, given the uncertainty in the market. But I still like it a lot. We're talking about a long-term hold on this one. I love it a lot. I'd be shocked if by the end of, let's say 2023, this is not a $200 stock. It absolutely should be. It's been unfairly maligned and kind of fallen in the weeds with all the other companies that don't deserve the high multiples. And it's not even trading in at all, a really high multiple, all things considered. But that's what I got for you, and I hope you have a great